Boeing reported $2.23 billion in net income last year, revenue up 34%. The headline called it a comeback, but operating margin was negative 6.1%. Free cash flow was negative $1.88 billion. Return on invested capital, negative 9.4%. And Invyra's fundamental quality score came back at 3 out of 10, a sell signal. Meanwhile, JP Morgan just opened a brand new $917 million position in Boeing. Smart money composite, plus 41 bullish. So here's the question. Is Boeing actually recovering, or is the market buying a story before the fundamentals have arrived? That's the question Invyra's earnings intelligence is built to answer. Let me show you exactly how it reads Boeing, number by number. First, a simple analogy for what's actually happening inside Boeing's financials. Imagine you run a manufacturing business. At year-end, your accountant reports $10 million in profit. You celebrate. Then you ask, where's the cash? The answer, customers haven't all paid yet. We recognize the contracts, but the money hasn't arrived, and we spent heavily on new equipment. $10 million in accounting profit. Cash in the bank, near zero. This gap has a name, accruals. It's the distance between what accounting rules allow you to report as profit and what actually clears your account. For Boeing specifically, there's a second layer. Even when cash does come in from operations, it gets consumed by the enormous capital expenditure required to build each aircraft. That's why operating cash flow, cash from running the business, can be positive, while free cash flow, after you subtract investment spending, turns negative. That distinction matters, and it's exactly what most investors miss when they look at a recovery headline. The default assumption for most investors, revenue up plus profit positive equals recovery in progress. Boeing's headline fits that template. Revenue growing 34% year over year. Net income positive for the first time in years. Aviation analysts forecasting a supercycle as airlines modernize aging fleets. That narrative isn't wrong. The demand is real. But a compelling recovery story and high-quality earnings are two completely different statements. And there's one ratio that separates them. The cash conversion ratio. Operating cash flow divided by net income. Above 1.0, every dollar of accounting profit is backed by more than a dollar of real cash. Quality earnings. Below 0.5, less than half of reported profit converts into cash. A warning flag worth investigating. Negative. The company is burning cash even while reporting profit. That's a structural signal, not a blip. Boeing's trailing 12-month free cash flow is still negative. And while it's improving from negative $1.88 billion a year ago toward negative $210 million today, it has not yet turned. The accounting has turned the corner. The cash hasn't fully followed. Let me show you exactly what that looks like inside Invyra. This is Boeing's research page on Invyra. Key metrics, fiscal year 2025. Revenue, $89.46 billion, up 34.5% year over year. Net income, $2.23 billion positive. On the surface, recovery confirmed. Free cash flow, negative $1.88 billion. Here's the important nuance. Invyra's valuation engine also shows trailing 12-month operating cash flow of $3.64 billion, positive. So Boeing is generating real cash from running the business. The problem is CapEx. Building commercial aircraft requires enormous upfront investment. And when that investment is subtracted, free cash flow goes negative. This is exactly the accruals gap in action. Revenue recognized, some cash collected, but the total cash bill of building those planes exceeds what's come in. Now, Invyra IQ, overall business quality. Boeing 3.0 out of 10. Sell signal? The breakdown is where this becomes specific. Efficiency, 2.2 out of 10. This measures how effectively Boeing converts capital into real operating output. 2.2 places it near the bottom of the S&P 100. Every dollar invested is returning far less value than industry peers, consistent with a return on invested capital of negative 9.4% against a cost of capital of 4.9%. Clarity, 3.2 out of 10. Earnings transparency. How reliable and consistent the reported profit actually is. A 3.2 reflects Boeing's layered accounting complexity. Long duration contracts, program cost deferrals, regulatory timing adjustments. What appears on the headline is several steps removed from what's happening in real cash terms. Momentum, 7.5 out of 10. The one bright spot. The operational trajectory is improving. Financial health, weak. 1 of 4 checks passed. 4 tests, return on invested capital at negative 9.4%. Failed. Target is above 12%. Debt servicing at 51.2%. Failed. Target is below 0.4%. Boeing is 128 times over the safe threshold. Current ratio at 1.19, passed narrowly. Debt relative to earnings before interest, taxes, depreciation and amortization, 7.40, failed. Target is below 3. Total debt stands at $45.9 billion against $20 billion in cash. That's not insurmountable, but it leaves almost no margin for error if the production ramp slows again. Now the trading picture. And this is where it gets genuinely interesting. Invyra Prism. Hold. Score plus 29. Prism detects favorable directional confluence. The direction signal is bullish. But momentum, timing, quality, and confluence are all neutral. In Invyra's own language, signals are conflicting. Wait for clearer alignment before committing capital. The technical indicators underneath Prism are more uniformly positive. Strong uptrend with price above both the 50-day and 200-day moving average. Relative strength, index, 64.4, bullish. Moving average, convergence. Divergence, positive 0.750, strong bullish. Williams percent range in bullish, accumulate territory. The stock is technically strong, but Prism's overall signal is hold, because technical strength alone, without quality and confluence confirmation, isn't enough for a high conviction entry. Smart Money Composite plus 41 bullish. Here's what's behind that number. JPMorgan Chase opened a brand new position, $917 million, 4.2 million shares. Capital Research Global Investors increased their stake by 121% in a single quarter. Sixth Street Partners initiated a $990 million new position. A QR Capital increased by 122%. Invyra flags this combination directly. Smart Money is buying despite premium valuation. Insiders may see catalysts not yet priced in. Invyra's intrinsic value estimate, based on financials through June 30th, 2026, $199.13. Market price, $231.67. Boeing is trading at a 16.3% premium to Invyra's estimated fair value. So let's hold all of this together. Fundamentally, Invyra's quality score rates, Boeing a sell, efficiency near the bottom, financial health 1 of 4. The earnings quality of what Boeing is reporting, positive net income while burning free cash, reflects a business where the accounting and the cash are still on different timelines. Technically, strong uptrend, bullish momentum, Prism hold waiting for fuller alignment, Smart Money plus 41, with multiple major institutions taking significant new positions. Invyra is not showing a simple picture. It's showing a market that is actively pricing in a future Boeing, the recovered, high-delivery, cash-generative Boeing of 2028 and beyond, before the current fundamentals have validated it. That's a legitimate thesis. But it is a thesis, not yet a result. I want to be precise about where I stand, because Boeing is not a simple short or a simple buy. The moat is real. 6.8 out of 10. A global duopoly with Airbus for commercial wide-body aircraft. That moat doesn't disappear because of a bad production cycle. And when JPMorgan, BlackRock, Capital Research, and AQR are all adding simultaneously, that's not noise. Those are institutions with access to management, order books, and production data that retail investors don't have. The free cash flow trend is also genuinely improving. Trailing 12-month free cash flow of negative $210 million is meaningfully better than negative $1.88 billion a year ago. If that trajectory continues, Boeing could reach positive free cash flow within the next 12 to 18 months. But here's where I draw the line. Paying 16% above Invyra's fair value for a company with efficiency at 2.2, clarity at 3.2, return on invested capital at negative 9.4%, and free cash flow still negative. That requires me to be right not just about the recovery, but about the timing and the price I'm paying for it. Prism itself says hold, wait for alignment. I agree with that framing. My personal rule, I don't enter a recovery thesis at a premium valuation until free cash flow turns consistently positive and efficiency shows a measurable upward trend. When those two things happen at Boeing, the story changes completely, and I'll look again. Until then, watch list, not portfolio. If you want to run the same analysis on any stock, efficiency, clarity, financial health, cash conversion, and the full picture across fundamentals, valuation, and smart money, Invyra calculates all of it automatically in one research view. Link in the description.